The Federal Reserve System, established in 1913 as the Central Bank of the United States, is a cornerstone of the nation's monetary framework, overseeing a money supply of $21,560 billion as of January 2025. Its operations shape economic stability through monetary policy, banking regulation, and financial services, while generating substantial revenue to fund its activities. This essay provides an extensive, detailed, and unbiased exploration of how the Federal Reserve earns money, identifying the revenue streams, their implementation, and the beneficiaries at individual, corporate, and agency levels. It also clarifies the Fed's unique private-public structure, examines oversight mechanisms, details how income is stored, and addresses criticisms raised in public discourse, including concerns about inflation, inequality, transparency, political influence, and moral hazard. Drawing on historical context from the First Bank of 1791 and integrating current data with global perspectives, this analysis aims to illuminate the complex financial operations of the Federal Reserve and their broader societal implications, ensuring a readable and engaging narrative. The Federal Reserve is entirely self-funded, relying primarily on interest earned from its portfolio of securities, which accounts for over 90% of its revenue. In 2023, the Fed reported a net income of $100 million, a sharp decline from previous years due to elevated expenses. But historically, it has generated billions annually, remitting significant sums to the U.S. Treasury to reduce federal deficits. The Fed's revenue streams include interest on U.S. Treasury securities, agency debt, and mortgage-backed securities acquired through open market operations, fees charged for financial services such as payment processing, interest on loans to depository institutions via the discount window, and earnings from foreign currency investments. Each stream is carefully managed to cover operational costs, including the Fed's 2025 budget, while ensuring excess funds benefit the public through Treasury transfers. The largest revenue source stems from open market operations, where the Federal Reserve purchases securities to influence the money supply and interest rates, a process coordinated by the Federal Open Market Committee. When the Fed buys a $1 billion Treasury bond yielding 4%, it earns $40 million in annual interest, contributing to its income. These purchases, executed through primary dealers like major banks, also involve capital gains or losses when securities are sold, though interest remains the dominant component. In 2025, with interest rates set between 4.75% and 5%, the Fed securities portfolio, including Treasury notes and mortgage-backed securities, generated substantial returns, supporting its role in managing the $45,560 billion federal debt. Another significant revenue stream arises from fees for financial services provided to depository institutions, such as check clearing, automated clearinghouse transfers, and FedWire funds transfers, which collectively earned $500 million in 2023. The FedNow service, designed for instant payments, and FedLine solutions, offering access to payment systems, further bolster this income. To reflect declining check volumes, the Fed increased certain fees by 10% in 2025, aligning with the Monetary Control Act's mandate to recover costs while competing with private sector providers. These fees ensure the Fed's payment systems remain efficient and accessible, supporting the banking infrastructure. The Federal Reserve also earns interest on loans extended to depository institutions through the discount window, serving as a lender of last resort. These loans, offered at primary, secondary, and seasonal rates, provide liquidity to banks facing short-term shortages, generating modest but critical revenue. In 2023, emergency credit facilities from the COVID-19 pandemic yielded $100 million, demonstrating the discount window's role during crises. While smaller than securities income, this stream reinforces the Fed's stabilizing function. Additionally, the Fed earns interest on foreign currency reserves, held at amortized cost in 2025, through investments or swap agreements with foreign central banks. These earnings, though minor, reflect the dollar's global prominence, with $8 trillion held in foreign reserves, contributing to the Fed's diversified revenue portfolio. Together, these streams are implemented through the 12 regional Federal Reserve banks and the Board of Governors, with the FOMC overseeing securities transactions and the board setting fees and loan policies. Congress mandates cost recovery for services, but the Fed independently formulates monetary policy, subject to congressional oversight, ensuring alignment with economic goals. The Federal Reserve's revenue benefits a wide array of stakeholders, from individuals to corporations and government agencies, though the distribution sparks debate. At the individual level, Federal Reserve employees, including economists, analysts, and administrators, receive salaries funded by revenue, with 2023 board expenditures reaching $1.1 billion for compensation. Senior officials, such as the Fed chair, earn approximately $200,000 annually, set by federal pay scales, ensuring competitive remuneration. Employees of commercial banks, as Fed member banks, indirectly benefit through statutory dividends of 6% on paid-in capital stock, totaling $1.5 billion in 2023. Bank executives and shareholders gain from policies like interest on reserves, estimated at $200 billion annually in 2025, boosting bank profits and personal wealth. On a corporate level, commercial banks profit significantly from Federal Reserve activities. Large banks, acting as primary dealers in open market operations, earn fees and benefit from liquidity provided by low-cost discount window loans and interest on reserves. These policies support banks managing $20.4 trillion household debt and $21.6 trillion business debt in 2024, enhancing their financial stability. Investment firms and hedge funds also gain from rising asset prices, driven by low rates and bond purchases, inflating the $48.2 trillion real estate sector. Service providers contracted for Fed operations, such as those maintaining payment infrastructure, receive payments from fees, though specific beneficiaries remain less publicized. Government agencies are key beneficiaries, with the U.S. Treasury receiving the Fed's excess earnings after expenses and dividends, a critical revenue source contributing to $5 trillion in 2024 federal revenue. These funds reduce the $1.9 trillion deficit, supporting agencies like the IRS and Department of Defense, whose employees and programs benefit indirectly. The Consumer Financial Protection Bureau, funded by the Fed at $700 million in 2023, employs staff to protect consumers, drawing directly from Fed revenue. The Treasury's Bureau of Engraving and Printing, costing $1 billion in 2023 for currency production, and the Secret Service, tasked with counterfeiting prevention, receive indirect support through Fed Treasury interactions, ensuring currency reliability. The Federal Reserve structure, a hybrid of private and public elements, shapes its revenue management. The Board of Governors, a federal agency, comprises 7 members appointed by the President and confirmed by the Senate, overseeing national policy. The 12 regional Federal Reserve banks, structured like private corporations, are owned by member banks, which hold stock and receive dividends. This model, established by the Federal Reserve Act, allows independence from congressional funding, with revenue covering expenses like the $1 billion currency production cost. Oversight includes congressional hearings, Government Accountability Office audits of non-monetary operations, and mandatory reports like the Annual Report and Budget Review, detailing assets such as Treasury securities and gold valued at $42.22 per ounce in 2025. However, monetary policy decisions are exempt from direct audit, fueling transparency concerns. The Fed's income is stored digitally as reserves and securities, not as physical gold or silver, which play minimal roles. Gold holdings, part of U.S. reserve assets, are valued at $42.22 per ounce, while silver is negligible. Most income derives from electronic securities, with excess earnings transferred to the Treasury, reducing physical storage needs. In 2023, a $133 billion deferred asset was recorded due to insufficient earnings, highlighting reliance on digital assets over commodities. Derivatives, monitored in central clearing, are not a primary income source, ensuring the Fed's financial operations align with modern banking practices. Critics raise significant concerns about the Federal Reserve's revenue practices, reflecting broader debates about its societal impact. Excessive money creation through bond purchases or low rates can fuel inflation, as seen in 2022 to 2023 price spikes, eroding purchasing power for fixed-income households while benefiting asset owners. Policies like quantitative easing boost asset prices, favoring wealthy individuals and banks earning $200 billion on reserves, exacerbating inequality in a $150 to $200 trillion economy. The Fed's opaque decision-making, despite public balance sheets, fosters distrust, echoing historical opposition to the first and second banks. By bailing out banks, as in 2008, the Fed may encourage risky lending, with $20.4 trillion household debt as evidence, creating moral hazard. Though independent, the Fed's appointed leadership faces accusations of political bias, particularly in election year rate decisions, undermining public confidence. Public sentiment, as seen in some online discussions, claims the Fed funnels profits to banks, paying $700 million daily via reserves and reverse repos, though these are oversimplifications, as Treasury remittances demonstrate public benefit. Revenue streams are formulated independently but guided by congressional mandates, with the FOMC setting open market policies and the board approving fees and budgets, including the $31,900,000 private sector adjustment factor in 2025. Public disclosures include balance sheets, annual reports, and FOMC projections, but transaction-level details and individual beneficiary data remain private, citing commercial sensitivity, intensifying transparency critiques. The 2024 Transparency and Accountability Policy aims to address concerns, though Reserve Bank's exemption from the Freedom of Information Act limits access, highlighting the tension between operational autonomy and public accountability. In conclusion, the Federal Reserve generates substantial revenue through interest on securities, service fees, loans, and foreign currency investments, funding its operations and transferring excess to the Treasury, which supports public programs and reduces deficits. Beneficiaries span Fed employees, bank shareholders, financial institutions, and government agencies, with indirect benefits to citizens through a robust economy. Its private-public structure enables independence but invites criticisms of inflation, inequality, opacity, moral hazard, and political influence, challenges rooted in its complex role. Managing a $100 to $115 trillion global money supply, the Fed's revenue practices are vital yet contentious, balancing economic stability with public trust. As debates persist, the Fed must navigate these criticisms, enhancing transparency and equity to maintain credibility in an interconnected world, ensuring its financial operations serve both economic goals and societal needs for generations to come.